Good day, ladies and gentlemen, and welcome to our class on scalping. In today's class, we're going to learn what scalping is, how scalping works, and what strategies work best for you. So yes, you can be a scalper. So today we're going to be discussing what is scalping and what are the best strategies. Now, scalping is a style of trading that aims to profit from small price changes in financial markets. Instead of buying and holding positioned over a longer time, scalpers make fast profits off of high volume of shorter trades, often lasting just seconds or minutes. Now, there is a difference between scalping and high frequency trading, but high frequency trading by definition is scalping. The theory behind the style is that smaller price moves are more frequent and therefore easier to capture than longer ones. Now remember, once you enter the market, when you're sitting on the sidelines, you have no risk. You're just a spectator. The minute you open a position, you are at risk. Okay, that's it. You can lose everything, you can make tons of profit, but you are at risk. You've entered the game. But your profit or your loss is only on the close. But the longer you are in the game, the more your risk increases. So if you can run in, take a little profit, and run out and run back in later, take a little bit more profit, instead of letting things risk, because the longer we're in the market, the more unpredictable and the more random it becomes. So by entering trades at a larger volume, even when a profits for pennies will add up, so does the risk associated with the position. Again, the longer you're in a position, the more risk you're exposed to. Scalping requires a strict trading strategy, which sets out exactly when to enter and exit positions and how much capital will be put up at each position. An exit strategy is particularly important to scalping because allowing just one trade to run losses could eliminate a large portion of any capital gained. Scalp traders will make use of take profits and stop losses to automate these entry and exit points. A scalper is the name of any individual who uses scalping trade style. Technically, scalpers are also day traders because they never hold positions open overnight. But there are a few traits that do set them apart. Scalpers are often extremely disciplined individuals due to the need to be strict about how long they keep positions open. They have the complete opposite opinion of let your profits run and will instead cut trades at very specific profit targets and even more strict levels of loss. Scalpers would never wait to see whether a losing trade will turn into a winning one. A scalper will also need to be able to dedicate a lot of time to monitoring financial moves, given that a pure scalper would be entering dozens, if not hundreds of trades each day. For this reason, it's very rarely a style of trading adopted by beginners or part-time traders, which is kind of a fallacy. Because when we're looking at making lots of little trades, making little bits of money, you can say, you know what? I'm going to trade everything I can between 9 a.m. and 11 a.m. this morning, because then I have to go off to the office, I have a meeting, I have to get the kids, whatever you have to do. But you can say, in that 2-hour window, that's my 2-hour trading window every day. Because there's no rule about how many trades you have to make and how long you have to trade. You just have to be aware that you need to be able to close those trades you open at 9 by the time you leave at 11. So scalpers can manually make decisions about when and what to trade, but they do not usually overlap with the class of traders that prefers to automate their trading strategy. In other words, they don't use robots, they don't use scanners. Due to the amount of work a successful scalping strategy takes, it can be more cost and time effective to use a computer program. This guarantees speed when it comes to entering and exiting positions and reduces the risk of trading based on emotion or bias. So basically what all it says is today, all today's modern platforms are computerized. You would set up many positions to execute at specific price points, setting up many different limit orders to be executed because when the euro reaches 109.62, you know you want to sell. Okay, you want to get out at this point. The computer's automatically set up to execute that trade when your circumstances are set. Scalp trading works by buying and selling large quantities of an asset, but only holding the position for a very short period of time. Scalp traders would either go long by buying or sell low or selling high, or go short by selling high and buying low. Having both avenues of profit enables scalp traders to find a much wider range of opportunities across rising and falling markets. To make enough profit from such small movements, pure scalpers would be entering dozens of trades each day. This means that you'll need to dedicate a lot of time to monitoring the markets. Due to the amount of work a successful scalping strategy takes, it can be more cost and time effective to use this computerized program like I mentioned. This guarantees speed when it comes to entering or exiting positions. Scalp trading can work manually with traders making their own decisions about when and what to trade, but usually scalp traders choose to automate their strategy. Ultimately, though, scalp trading looks different depending on the market you're interested in. Let's take a look at two common asset classes: securities, stocks, and Forex. Traders who adopt this style rely on technical analysis rather than on fundamental analysis. Technical analysis is a way to access a security's past price movement. Traders use charts and indicators to find trading events and create entry and exit points. Now, when you're scalping, you don't really care about economic events at all. You don't really care about that much about technical analysis. You care that something has climbed up 18 points over the last hour. Well, you know it's going to give back some of those points. Okay, so it's time to sell. Something's fallen a lot. It's time to buy. We're only concerned with the most current movement, the last 5, 10, 15 minutes. Scalpers can observe an asset price action with the day's trading prices open in real-time charts using indicators and known patterns. They try to predict how price will move in the next few seconds or minutes. Then they set up low and high trading points and use them to enter and exit trades. Understanding market execution and market order execution is very important. Sometimes a great way to trade using scalping is with an OCO. One cancels the other. So in contrast, fundamental analysis involves using data from a company's financial statement to calculate ratios that help access values based on investing goals, hence the word investing. This allows traders to evaluate a company and manage risk for growing their wealth over time. Scalpers may trade on news or an event that alter a company's values upon its release. In some cases, they might use short-term changes in fundamental ratios to scalp trades, but for the most part, they focus on technical indicators and price action on their charts. Since these charts indicate past price, they lose value if the time horizon increases. The time horizon is how long a position is held. The longer a scalper holds a position, the less value that position tends to have for them. That is why technical analysis and trading indicators work better for the short-term nature of scalping. Now, in theory, day trading and scalping are alike, but they aren't the same. Scalping is a form of day trading, but not all forms of day trading are scalping. For instance, a day trading position can be kept open if the markets are open. For example, a day trader could open a position right when the market opens, say at 9:30 in the morning, and close it right before the market closes at 4 p.m. That would still be a day trade even though the trader held it open for more than 6 hours. On the other hand, a scalper rarely holds a position open for more than a few minutes. It's more common to see scalpers trading time frames measured in seconds and minutes, not in hours. Trading within such small time frames means that scalpers might need to use computer programs that automate these trades. A day trader who uses longer term strategies may be less likely to automate their trading programs. Scalpers feel it's simpler to make small deals that are reduced in risk from the perspective of the market volatility. Remember, if you're only looking to make a couple points, your loss is also very minimum. Your risk is very minimum. So your potential loss is very minimum. Okay. And volatility can stay out of the picture. You make a small profit when the going is good, before your opportunity disappears. Scalp traders who indulge in online trading are on the other side of the trader spectrum, where you have traders who hold on to promising securities, often waiting months to see some profit. Scalpers create multiple small profits instead of one large bundle. In other words, the euro is trading at 109.62 and you thought it was going to fall back down to 106. Okay. A short-term online trader might sell the euro at 109 and even set a target point at 106. Okay. While he's waiting for it to get to 106, he's facing a lot of potential risk factors, where a scalper might open at 109.6. He assumes it's going to go to 106. The minute it falls to 107.52, he closes his position. He takes his few points. He might reopen another trade at 107.50 to go short again. And by the time it hits the 106, he's had 4 positions open, and they're all 4 profitable. Now, if you calculate how much he made to how much the CFD trader had made, well, the CFD trader had actually made more profit because each one didn't have spreads and costs going up and down and up and down. But he held his trade open for hours, facing more and more risk. Statistically, the more risk you have and the more your trade opens, the more likely that profits, because if the asset fell all the way down to 106.52, not to 106 and then turned back up, that CFD trader was out of luck. Where the scalper, he had already locked in his profit, sold it out his first trade, his second trade. The third trade might have turned into a small losing trade. That's the end of it. Or maybe he didn't enter the market for that third losing trade. Now, there's 5 primary types of scalp trading, or 5 primary trading strategies. One, we will look at market timing. Market making happens when a scalper tries to profit off the spread by simultaneously posting a bid and an offer price for a same contract. That's what we call OCO. And you can set up an OCO order. One cancels the other. This strategy succeeds mainly with immobile securities that can trade at significant volumes without massive price changes. Market making is the most challenging scalping strategy to execute, as scalpers must compete with market makers for the share on both bids and offers. Then we have arbitrage. Arbitrage has been around for a long time. I don't even understand. It's not that I don't understand it. I don't know how you would do it in today's CFD market. Now, arbitrage for cryptocurrency is kind of unique because there's so many cryptocurrency exchanges around the globe that not all of them are buying and selling, say, Bitcoin at the same price simultaneously because they're getting their data from somewhere else. So you might be trading on one platform in Brazil and another platform in Japan, and one hasn't caught up to the other. They're independent, and one's offering Bitcoin at 16500 and the other is offering to buy Bitcoin at 16502. Okay. Now, you could sell your Bitcoin over there, buy your Bitcoin over there, and sell it to the one guy at one, and that's arbitrage. It used to be quite popular till cryptocurrency got as big as it is, and most of these big national exchanges use instant data. But because there's no centralized exchange, getting those exact prices are sometimes leave wobble room. And you can use arbitrage very well. And then, of course, we have price action trading. Scalping the markets with price action is similar to trading with other price action strategies. This strategy is based on analyzing the asset's price movement. It involves buying shares or assets or contracts on any setup from your system and leaving the position as soon as the first exit signal is generated. Scalpers who adopt this trading style depend on technical analysis rather than fundamental analysis. We use things like chart patterns, Fibonacci levels, we'll use support and resistance levels, and we will find entry and exit points accordingly to the price movement. In contrast, fundamental analysis involves examining both macro and micro factors for determining a security's intrinsic value, such as the overall state of the economic landscape. Who cares? When looking at price action trading, we're looking for something that's going to show us a breakout, whether it's a break up or break down, or a level of support or resistance that is holding or being about to be broken. While scalpers may trade on news events or small fundamental changes, they primarily focus on technical analysis, technical indicators, and charts. For price action trading, I primarily only rely on charts, chart patterns, support and resistance, and eyeballing, looking at my chart and understanding. We do have candlesticks that there are certain patterns, and don't memorize patterns. But when you see certain things happening with candlesticks, we can turn them into quick decision making. And then we have margin trading. Scalpers can trade derivative products such as CFDs on an underlying asset's price movements, whether a currency pair, security, or commodity, allowing them to trade with leverage. So in other words, you have $1,000 in your account and a particular asset class is offering 100 to 1 leverage. That means you can trade 100 times the 1,000 or $100,000 of that asset. Well, that means all you need is that euro is to change a couple pips and you've booked a nice small profit. And then lastly, we have high frequency scalp trading. High frequency trading is fast paced trading. I can't even do it. It's faster than my brain can think. They use automated software to initiate hundreds of orders in seconds. It uses complex algorithms to study multiple markets and execute orders based on market conditions. Now, as a trader, you can purchase from a lot of independent sources these computer programs. Or if you're using things like MT4, you can add on an expert advisor that will give you all of this information. And all you have to do is kind of customize it to how you want, how your strategy works, your money, your risk, all the other things, and you just let it go to work. So there's some pros and cons of scalping. Scalping can be tremendously lucrative if executed with a rigorous trading strategy. The method doesn't require traders to follow a security's fundamentals. Scalping offers numerous opportunities for leveraging small changes in the price of an asset. Scalping is a non-directional strategy and can be used as long as a market is moving up or down. Scalping allows for automation within trading systems you use. Some of the cons, though, are, and you should always beware of benefits and drawbacks. Scalping requires a trader to have an unyielding discipline, particularly when it comes to an exit strategy. Relatively high transaction costs. You're paying the spreads for entering and exiting a trade, sometimes several times over because you're entering and exiting so many trades in a movement. Needs greater leverage to see substantial profits because you're trading for only a few pips profit. You can't trading 20 shares of an asset, and even though the shares are costing you $50 a piece and you're buying 100 shares of them, that's still a $5,000 investment. But if it only moves $1, it's not much profit. But if you ramp up leverage, when you ramp up leverage, you're also ramping up potential loss and risk. It's very demanding in terms of requiring high levels of concentration. Entry points can appear and disappear quickly. A profitable scalping strategy requires dozens to hundreds of trades a day. Forget the hundreds of trades a day, dozens. The amount of attention and commitment demanded by the method can be highly stress-inducing, particularly for ill-equipped beginners. If you're going to do scalping, start out slow. Learn to use a lot of the tools. Master the tools. Master scanners. Master your robots. When you can do regular trading, day trading. Not day trading, but CFD trading, short-term trading. Maybe you want to try scalping. Find a robotic system, find an automated system, get to know it, adjust it to your risk tolerance with your strategy. Test a long time on a demo platform. But all in all, for traders who adhere to strict trading discipline with effective execution and exit strategies, scalping can be very lucrative as small profits compound quickly into heftier gains. And I'll go back to the same thing I said to you earlier. When you're not in a trade, you're sitting on the sidelines. You're just a spectator. The minute you enter a trade, what happens? You don't make profit, you don't make loss. The minute you enter a trade, you enter risk. And the longer you're in a trade, the more risk that is opposing you and the more risk that could happen. And profit or loss is only decided at the exit of the market. So regardless of what happened in between, you can whine and cry or be happy or say whatever. Until you've exited that market, you can't say whether you made a good trade or not a good trade. You can't say whether you made profit or loss. So keep that in mind. The longer you're in a trade, the more risk that's out there. However, no trading method is guaranteed to provide profits only. Therefore, it is paramount for scalpers to have a good risk management strategy in place. Always know what you have at risk. Always realize you can lose your money. So on that note, thank you very much. That's all, folks. And join us for our next webinar. Bye now.